Good afternoon. My name is Tony McCall, and I'm from Montgomery, Alabama. And my question is about your disciplined risk evaluation approach and how you balance that with the fact that perseverance and determination and grit are often necessary for success.
Well, I certainly like determination and grit with the people we work for, but we don't have any formula that evaluates risk, but we certainly make our own calculation of risk versus reward in every transaction we do. And it's true whether it's marketable securities, that's true whether it's private investments, that's true whether it's making an investment in a business. And sometimes we're wrong, and we're going to be wrong sometimes in the future. You can't make a lot of decisions in this business without being wrong, but we don't think the procedure or the results would be changed favorably by having lots of committees and lots of spreadsheets and that sort of thing. It just, if I had a group under me, they would try and figure out what I wanted the answer to be, and they would tell me what I wanted to hear. And I've watched that approach at 20 public companies, and what the CEO wants to do, they may spend a lot of time getting there, but the investment banker gets there, and the internal committees get there, or the internal operations get there. The calculations are it's the same as the insurance business with a G. A G gets calls on insurance deals, and you have to think through that deal. The main thing is, are you reasonably sure that you know what you're doing? And it gets past that hurdle, then we go on to figure out the math of gain versus loss and how much loss we can afford to take in anything. And we're willing to take what sound like large losses if we think that the rewards are more likely and proportional. Charlie?
I got nothing.
Yeah, it's very disappointing. We have no formulas around Berkshire. We don't sit down and write a bunch, have people work till midnight calculating things and putting spreadsheets together. And if the hurdle rate is 15% or something, having them all come out at 15.1 or 15.2, because that's what's going to happen. I mean, you're going to get the numbers you want to hear. The proposals we receive from the investment world, I've got to tell you about one because it illustrates, go on. We received a proposition the other day, and I'll disguise the numbers a little bit so nobody can pick it out. But it was a private company, and we'll say it was earning $100 million a year. But the seller of the business and the investment banker suggested that we should look at the earnings as being $110 million a year. Because as a private company, they had to pay their top people in cash, which was expensed, but we could pay them in stock options and things like that, which weren't expensed or were explained as not really counting, and therefore we could report $110 million if we gave away something we didn't want to give away. But by sort of lying about our accounting, we could add $10 million to earning, and they wanted us to pay them because they couldn't do it, and we could do it, and therefore, at this point, they're losing me, of course, totally. But it's just astounding the accounting games that are played. All the adjustments are why the place will be earning more than before. It's a business. We also had one that came in from a private equity firm, and by a mistake, we got the email that was sent to the manager from the private equity firms that owned it, to the manager in terms of making projections for it. And they told him to add 15% because they say Buffett will discount it by 15% or 20% anyway. So just add 15% to offset his conservatism. It's not an elegant business, as Charlie will tell you. You have any better stories, Charlie?
It's bad enough.
Okay, Andrew.
It's really very bad enough.
Thank you, Warren. I think this.
Why do we want our leading citizens lying and cheating?
Andrew?
I believe this is my final question, and admittedly it's a two-parter, but it's the same topic. Elon Musk says that Tesla will start to offer insurance for its cars and can price it better than a typical insurance company because of the data it collects from all the vehicles on the road. You've talked about the threat of autonomous vehicles on the insurance business, but what about the threat to GEICO of automobile companies themselves getting into the insurance business? And on a very similar topic, Tesla recently announced that they're shifting to an online-only sales model, and several traditional auto dealerships are also reducing their property holdings as car buyers increasingly use smartphones and the internet to shop for cars. What does this portend for Berkshire Hathaway Automotive?
Yeah. Actually, General Motors had a company for a long time called Motors Insurance Company, and various companies have tried it. I would say that the success of the insurance company, of the auto companies getting into the insurance business, are probably about as likely as the success of the insurance companies getting into the auto business. I worry much more about Progressive than all of the auto company possibilities that I could see in terms of getting an insurance business. It's not an easy business at all, and I would bet against any company in the auto business being any kind of an unusual success. The idea of using telematics in terms of studying people's driver's habits, that's spreading quite widely, and it is important to have data on how people drive, how hard they brake, how much they swerve, all kinds of things. So I don't doubt the value of the data, but I don't think that the auto companies will have any advantage to that. I don't think they'll make money in the insurance business. Using the internet to shop for cars is like using the internet for shopping for everything. It's another competitor, and there's no question that people will look for better ways. Now, the gross margin on new cars is about 6% or thereabouts. So there's not lots of room in the game, but that will be a method, and that will sell some cars. And if there are, it's another competitor. But I don't think it destroys the auto dealer who takes good care of the customers and is there to service the customers. And it's not an overwhelming threat, but it's obviously something that's going to be around and will sell some cars. Charlie?
Again, nothing.
Okay. Greg?
Warren, a lot of Berkshire's success over the years has come from the fact that you and Charlie have had the luxury of being patient, waiting for the right opportunities to come along to put excess capital to work, even if it has led to a buildup of large amounts of cash on the balance sheet. This has historically worked out well for shareholders, as you and Charlie have been able to take full advantage of the disruptions in equity and credit markets, or special situations like we saw with the Oxy deal, to negotiate deals on terms that ultimately benefit Berkshire shareholders. That said, there is an opportunity cost attached to your decision to hold on to so much cash, one that investors have been willing to bear, primarily by foregoing a return of excess capital as dividends and share repurchases, as well as seeing lower returns on cash holdings. As we look forward, how certain can we be that this will still be the case once you're no longer running the show, especially if Berkshire's returns are expected to be lower over time? And is it not more likely that the next managers of Berkshire will have to manage the eventual migration of Berkshire from an acquisition and investment platform to a returning capital to shareholders vehicle?
Yeah. Well, that's certainly a possibility. I mean, that's a possibility under me. It's a possibility under the successor. I mean, it's a question of, can you invest truly large sums reasonably well? You can't do it as well as you can do small sums, so there's no question about that. But we will have to see how that works out over many years, because certain years, lots of opportunities, huge opportunities present themselves, and other years are totally dry holes. So that's not a judgment you can make in a 1-year period or a 3-year period. It's certainly a judgment you can make over time, though. And I personally, my estate will have basically nothing but Berkshire in it for some time as it gets dispersed to philanthropies. And I have a section in there which says to the trustees, in effect, who manage it. I have a section in there that says, ignore you're exempt, from my standpoint, from the law that trustees normally should diversify and do all of that sort of thing. And I want the entire amount that they have to be kept in Berkshire as they distribute it over time to the philanthropies, and I don't worry at all about the fact. I would like to have a very large sum go to the philanthropies, and I don't worry at all about the fact that it essentially will all be in Berkshire. I'm willing to make that decision while I'm alive, which will continue for some years after I die. So I have a lot of confidence in the ability of the Berkshire culture to endure, and that we have the right people to make sure that that happens. I'm betting my entire net worth on that, and And that doesn't give me pause at all. I rewrite my will every few years, and I write it the same way in respect to the Berkshire holdings. Charlie?
Well, I don't own any indexes, and I have always been willing to own just 2 or 3 stocks. And I have not minded that everybody who teaches finance in law school and business school teaches that what I'm doing is wrong. It isn't wrong. It's worked beautifully. I don't think you need a portfolio of 50 stocks if you know what you're doing. And I hope my heirs will just sit.
My heirs hope that I'll change my will.
Okay.